Tyler was 23. He had a job, stable income, nothing crazy, but enough. He found an apartment he could actually afford. First one in months that wasn't a shared bedroom or a 40-minute commute. He filled out the application, he paid the application fee, he waited. Denied. Not because of his income. The landlord told him straight. It was his credit. His score was too low to qualify. Tyler had no idea he had a credit score. He definitely had no idea it could stop him from renting an apartment. He thought credit was something that mattered when you were older, when you were buying a house or a car or something big. Not at 23, not for a one-bedroom in a mid-level building. But that's the thing about the wasteland we're all navigating out here. There are invisible systems running in the background, quietly deciding what you have access to and what you don't. Most people don't find out those systems exist until they run into a locked door. Tyler's locked door was an apartment. Yours might be something different, but the key that opens them is the same. It's called a credit score. And by the end of this video, you'll know exactly what it is, what determines it, and how to start building one that actually works in your favor. Think of your credit score like your reputation stat in a game. Every settlement you walk into in the wasteland, every trader you try to deal with, they check your reputation before they decide what terms you get. High reputation, better prices, more access, more trust. Low reputation, doors closed, worse deals, or flat out turned away. Your credit score works exactly like that in the real world. It's a number between 300 and 850. That's the full range. The higher the number, the more financial institutions trust you. The lower the number, the more they see you as a risk, and they either charge you more to compensate for that risk, or they don't deal with you at all. What does it actually affect? More than most people expect. Apartment applications, like Tyler's, car loans, and the interest rate you get on them. Eventually a mortgage, sometimes phone contracts. In some states, employers can check it too. Credit cards and the rates attached to them. Here's the part that makes this worth caring about right now, even if you're not thinking about any of those things yet. The score you build or don't build in your early 20s follows you directly into the years when those things matter. There's no reset button. So what actually determines the number? 5 things feed into your credit score. You don't need to memorize all of them, but you do need to understand the big ones because 2 of them are responsible for most of the damage people accidentally do to themselves. The biggest one, 35% of your score, is payment history, whether you pay your bills on time. That's it. Pay on time, this works in your favor. Miss a payment, it hurts. Miss one by 30 days, and it shows up on your credit report and stays there for 7 years. Not forever, but a long time. This is the thing Tyler didn't know. He had one credit card, opened at 19, and he missed 2 payments in a row during a stretch when money was tight, and he forgot to set up autopay. 2 missed payments, the whole score tanked. The second biggest one, 30%, is something called credit utilization. And this one trips people up constantly because it's not obvious. Here's what utilization means in plain English. Say your credit card has a $1,000 limit. If your balance sitting on that card is $900, you're using 90% of your available credit. That 90% is your utilization. And high utilization, even if you pay it off every month, even if you're technically managing it fine, tanks your score. The general guidance is to keep it under 30%. So on a $1,000 limit card, that means keeping the balance below $300 when your statement closes. Under 10% is even better if you can manage it. Most people have no idea this exists. They pay their bill on time every month and can't figure out why their score isn't moving. It's because the balance on the card during the month still counts, even if it's gone by the due date. The fix? Either spend less on the card or pay it down before the statement date rather than waiting for the due date. Small change, real impact. Those 2 factors, payment history and utilization, make up nearly 2/3 of your score on their own. Get those 2 right and you're most of the way there. But there are a few other things worth knowing because people accidentally hurt themselves with these without even realizing it. The length of your credit history matters. It's roughly 15% of the score. Longer history scores better. This is why closing an old credit card, even one you never use, can actually hurt you. That old card has history attached to it. Kill the card, lose the history, score drops. Pretty simple. If a card has no annual fee, the easiest move is usually to leave it open and put one small recurring charge on it so the card company doesn't close it automatically. The types of credit you have makes up about 10%. Credit cards, loans, different kinds of accounts. You don't need to go out of your way to game this. It just naturally improves as your financial life develops. New credit applications make up the last 10%. Every time you apply for a new card or loan, the lender does what's called a hard inquiry. They pull your credit report to assess the risk. Each hard inquiry causes a small, temporary dip in the score. Applying for 5 cards in a month looks like desperation to the scoring system and hits harder. Space out applications. Don't open a bunch of accounts at once. 5 factors, 2 big ones, 3 smaller ones. That's the whole system. Now here's the question Tyler actually needed answered. How do you build a score when you barely have one or fix one that's already taken damage? A lot of people in their early 20s have what's called a thin credit file. Not bad credit, just almost no credit history at all, which weirdly can be almost as limiting as bad credit because there's nothing for the system to evaluate. The fastest and simplest way to start building from nothing is a secured credit card. A secured card works like this. You put down a deposit, right? Usually between $200 and $500, and that deposit becomes your credit limit. You use the card for small purchases. You pay the balance off every month before the due date. The bank reports that activity to the credit bureaus, your history grows, your score builds. After several months to a year of responsible use, most secured cards convert to a regular card and return your deposit. The score you built in the meantime stays. It's the entry-level quest in the game. Low stakes, repeatable, builds the stat you need to unlock the next thing. A great starting point for beginners. If someone in your life, a parent, a partner, a trusted family member, has a credit card with good history and is willing to add you as an authorized user, that account's history can show up on your credit report. You don't have to use the card. You don't even need to have the physical card in your possession. Just being listed as an authorized user on a healthy account can give your score a big boost, often within 1 or 2 months. The catch: if that person misses payments or has high utilization, it can work against you too. The health of their account is what you're inheriting. Only do this with someone whose financial habits you genuinely trust. Tyler's mum agreed to add him as an authorized user on a card she'd had for 12 years. Clean payment history, low balance. Within 60 days, his score had moved enough that the system had something real to work with. A few things worth steering around because they'll make the problem worse, not better. First, credit repair companies. These are services that charge monthly fees, sometimes significant ones, to fix your credit. Most of what they do is either dispute negative items on your report, which you can do yourself for free through the credit bureaus directly, or promise things they legally can't deliver. Legitimate negative marks on your report, like Tyler's missed payments, cannot be removed before their natural expiration date. Anyone who tells you otherwise is selling something you likely won't benefit from. Next, closing all your cards because credit feels scary. This one comes from a good place, but it backfires. Closing cards removes available credit, raises your utilization percentage, and shortens your history. The better move is to keep the cards, use them minimally, and pay them off. Lastly, maxing out a card and making minimum payments to show you can handle credit. This shows the opposite. High utilization plus minimum payments is a pattern the scoring system interprets as someone who is stretched. Pay the balance off. Keep the utilization low. That's the signal the score responds to. So, how long does this all take? Honestly, it depends on where you're starting. If you have no credit at all and you open a secured card today, you can have a functional credit score within 6 months. Not a perfect score, but enough to start accessing the basic things you need. Enough to get Tyler into that apartment. If you have damaged credit, missed payments, high utilisation, collections, the timeline is longer. Negative marks fade in impact over time, even before they fall off completely. A missed payment from 3 years ago hurts you less than a missed payment from 3 months ago. The most effective strategy is to stop adding new damage and let the existing marks age while you build positive history on top of them. 2 years of clean behaviour on top of messy history starts to change the picture meaningfully. 5 years, and the old damage is mostly buried under the new record. You're not starting over, you're just building on top of what's there. Do you know your credit score right now, even roughly? Drop it in the comments if you feel comfortable doing so. Let us know how you got there and what your plan is to improve it. Tyler got added as an authorised user on his mum's card. He opened a secured card of his own with a $300 deposit. He put his Netflix subscription on it and paid the balance off the week before the statement date every month. He checked his score on Credit Karma every few weeks because he was obsessed with watching it move. 6 months later, he applied for a new apartment. Different building, similar price range. Approved. Not because his life changed dramatically, not because he figured out some loophole. He just understood the system he was operating in, did the 3 simple things the system responds to, and let time do the rest. The wasteland didn't get easier, he just got better stats. Check your credit score. Free. No hard inquiry. Credit Karma, Experian, or annualcreditreport.com. Just know the number you're working with. If you have no credit, look into secured cards. Most major banks offer them. Put one small recurring payment on it. Pay it off monthly. Leave it alone otherwise. If you have someone in your life with good credit, ask about becoming an authorized user. Explain what it means. It costs them nothing if their habits are already clean. If you have damaged credit, stop adding new damage first. Then focus on paying everything on time from this point forward and work the utilization down on any active cards. That's the whole repair plan. Your credit score isn't your worth. It's just a stat, and stats can be leveled up. The system wasn't designed to be obvious. It wasn't designed to be taught in school. It was designed to be discovered late, after the locked door, after the bad interest rate, after the moment you realize something has been deciding your options without your knowledge. You know how it works now. Tyler's apartment story doesn't have to be yours. Go check the number, build the stat. Come back when you're ready to understand how your credit score connects to the debt situation, because those two things are linked in ways that matter. And there's a full breakdown on getting out of debt on this channel if that's where you're at right now. Stack smart.